Hello everybody and welcome back to my channel. I still owe you some additional remarks on international taxation. It's a long time ago that I made the last video from that series, but here is the one or other additional remark. In the third chapter there, I still owe you some examples how business income is treated and which rules apply there. So let's just have a look. So the first probably important thing which we have to remember is how do case solutions work. And you remember that the first question we had to pose was always, where is the taxpayer resident? So the personal status had to be clarified or determined. And then afterwards we have to ask ourselves how the event itself can be treated. So if the non-residence country may levy a tax or not, and if so, or how the country of residence then must react. Let's look to a concrete example. A German AG has a shop in Paris, and this shop makes a profit of 200,000 euro. So the first question is, where is the GmbH resident? And the answer will be, it is resident in Germany, because a German AG will have seat and headquarter, so place of management, both in Germany. So it will only be unlimited tax liable there, with the consequence that only Germany can play the part of the residence country. Now the events. There's only one event mentioned, the profit from the shop in Paris. So our first question must be, can France as source country levy a tax here or not? Article 7 of the OECD Model Convention just tells us business profits can only be taxed in the country of residence, that would be Germany, apart from the case where that enterprise has a permanent establishment in the other country, that would be France. Now they have a shop in France, and that is a permanent establishment. You can make that certain if you look it up in Article 5 of the OECD Model Convention. Permanent establishment is a fixed place where somebody has established his business and runs it partly or completely there. That is what they do in the shop. So France may levy a tax. That's the outcome of Article 7.1. And the next question is then, how does Germany react to avoid a double taxation? And that's always Article 23, as you remember. This article exists in two variants. Germany applies always the 23A variant, that is the exemption method variant. So that says if France levies a tax, then Germany exempts this income from German taxation. That's always the rule, apart from the case of dividend income and interest income. You remember that. So that's how a simple case would work. Again, some other training case. For example, taxpayer H from Hanover has a factory in Italy. That's a sole tradership. And as you see here, the complete factory is in Italy. The taxpayer is in Hanover. That factory makes a profit of 300,000. And now let's look to the solution. We must look for the residence of the taxpayer. And here's a surprise. Although the complete factory is in Italy, a factory is not a person, neither natural nor juridical one. So we have to look for the owner, and the owner is taxpayer H, resident in Hanover. So the owner is resident in Germany. Now we look to the events. Can Italy levy a tax? Article 7 OECD Model Convention is again the relevant article. It says that business income can only be taxed in the country of residence of the taxpayer. That would be Germany, because he lives in Hanover. However, if the owner has a permanent establishment in the other country, so if there is a permanent establishment in Italy, then Italy can tax the complete profit of that permanent establishment. Now let's have a look here. The factory is located in Italy. A factory is definitively a permanent establishment because it's a fixed place of business where business is run. So yes, the factory is a permanent establishment. Italy is allowed to tax the profit from that factory, and as this is the complete enterprise, it automatically follows that the complete profit can be taxed by Italy because it's the one and only permanent establishment of that enterprise. So Italy can levy a tax. How does Germany react? It's again Article 23 in the A variant, which says whenever under this double taxation treaty Italy can levy a tax, Germany will exempt that profit from German tax. So the outcome is Italy levies a tax, Germany declares that profit as tax-free in Germany. However, you know that Germany can freely determine how it taxes all the other income of the taxpayer. So especially what we are always able to do is to decide on our own how we tax the remnants of age income. So, for example, his rental income, his job income from a job in Hanover, and so on. And especially, we can fix the tax rate on this income however we want to do, especially we can fix it on the basis of his complete worldwide income. So the proviso safeguarding progression is always allowed, and although there is an exemption, we naturally can take into account this profit for the auxiliary calculation which we make if we want to determine the adequate personal progressive tax rate under income tax for a natural person. That is clarified in paragraph 3 of Article 23a. However, that clarification is only a clarification. That means if you would delete this paragraph from Article 23a, it would not change the situation, because under the general principles of the DTTs already, every state, the DTT just decides which state can decide which income, and the rules, how we tax it, and how we fix or set the tax rates, that is just on us to decide. We are completely free on which criteria we decide that. So we, with regard to the tax rate for the remaining income of age from other sources, we are completely free to look to the worldwide income. Okay, another example. GmbH I from Ingolstadt in Germany has its head office in Ingolstadt and a factory in Ingolstadt plus a factory in Italy. So there are two permanent establishments. Evidently, one is Ingolstadt and the second one is in Italy. Now, the factory in Italy produces a car and sells it for 30,000 euro, but the head office in Germany does the bookkeeping, the invoicing, and all the similar bureaucracy stuff. Yeah, what does that mean? First, the interesting thing is that here, in dealing with that transaction, the German part of the enterprise and the Italian part of the enterprise work together. So we can't say that one transaction is completely attributed to one of the permanent establishments. They shared the work, and in that case, the OECD Model Convention, Article 7, paragraph 2 says, if a permanent establishment does only a part of the work, then the profit has to be distributed between them as if they were independent enterprises. So if the headquarters does some service for the permanent establishment in Italy, then Italy, the Italian permanent establishment, must be treated as if they had to pay for the head office an adequate market-conform remuneration for that part of the transaction which was done by the head office. Now, we can only look or find out that what would be such a market-conform remuneration if we look to the market, or in cases if we ask the case data, if there's any information on the market-conform remuneration. Here in the last line, if the factory in Italy had given an order to do this work to an independent enterprise, a bookkeeping or invoicing company in Italy, it would have been charged with a fee of 2,000 euro. That gives us the decisive hint. So our solution will be first, who is the taxpayer? Taxpayer is the I GmbH, and it's resident in Germany because there it has its seat and place of management. That it has a permanent establishment in Italy doesn't change anything, because personal tax liability and corporation tax just depends on the registered office, in German often called the seat, and the place of management, or nothing else. A permanent establishment is not enough to trigger a worldwide income taxation in any country here. So only resident in Germany. So the next question is then again the events. Can Italy levy a tax? And Article 7.1 says yes, it can, because the car was produced by, in part at least, by an Italian permanent establishment. So under Article 7.1, Italy can levy a tax on the profit. However, how high that profit was, which the Italian permanent establishment caused, that has to be determined as if these two PEs involved in the transaction had dealt with each other under market conditions. So we must do as if the Italian part of the enterprise had to pay 2,000 euro remuneration for the headquarter in Germany as a market-conform remuneration for the services they did in connection with the transaction. So 28,000 remain as taxable part of the profit in Italy, and the 2,000 were caused by the work of the headquarter, so they are attributed only to the headquarter in Germany. So 28,000 can be taxed by Italy. How does Germany react? It's again 23a, the exemption article, which says that what the Italians can tax and do tax will be exempted from tax in Germany. Okay, seems to be easy and is easy. Let's look a bit more to some concrete small cases and how we would solve them, perhaps in an exam or something like that. So the German testified GmbH is probably called with a very awkward English name, probably that's usual with Germans. We all don't know about English, and so we just muddle through. Well, it's an auditing firm, and it has specialized on international financial reporting standards, financial reports. So the GmbH has some business to do worldwide, because the IFRS are identical worldwide. However, the GmbH as a GmbH naturally has been registered in Germany, and the place of management is also in Germany, in Munich. Now, as I just said, they have some international orders. So last year, because of an order from a company in the USA, 3 employees of the GmbH were sent for 4 months to New York in order to check the accounting of a US subsidiary of a client. Let's say, for example, they suspected that there were some fraudulent activities going on, so they had to check the accounting if everything was properly done. And in the end, the 3 auditors worked there for 4 months, lived in a hotel or so, checked everything, and in the end naturally wrote a nice invoice. And so from that order, the testified GmbH made a profit of 100,000. And naturally, now the decisive question is, can the USA tax a bit of that prey, of that profit? That's our question, and that is what we have to look into now. So let's have a look. For the solution, we begin as always with checking the residence. And for the testified GmbH, it's clear that it's resident in Germany under Article 4.1 and only in Germany because it's only subject to a worldwide taxation in Germany. Then we go to the events, or here only one event, the order or service which our GmbH renders to its American customers in the USA. The first question is, may the US levy a tax? And the answer is Article 7.1 of the OECD Model Convention. Yes, it may not, because only the country of residence is allowed to tax business income. Apart from the cases where there is a permanent establishment abroad and that permanent establishment makes this profit. Now, that's not the case. They don't have a permanent establishment abroad, because if employees just work in the US for 4 months and live in hotels and only visit the customer, then they have no rent, or the GmbH has no own rented or bought premises in the US, so no fixed place of business of theirs exists there. So the US may not levy a tax on this profit, which means automatically that the question, how must Germany react to avoid double taxation, leads to a very simple answer. They must do nothing, because the 23A or 23B article only applies if the other state may levy a tax, and that's not the case. So Germany has no obligation whatsoever in this peculiar situation. So that's it. Case is solved and closed. Let's go to the next case. Our small case number 2 is about the German beer brewery GmbH, and it has its seat, so registered office, and its place of management in Aachen, Germany, very near to the Belgian border. And after producing the beer, they store the beer in a storage room which is 200 meters away, but on Belgian territory. From there, the beer is later transported to the customers who ordered it. So, what does that mean? What happens there? Who can tax the profits from the beer, or which portion of the profits? Let's have a look. So, let's begin again with the residence of the taxpayer, and here we can see that the German beer brewery GmbH is only resident in Germany, Article 4.1, so we don't need to use any so-called tiebreaker rule in 4.3. The events is production of beer and storing it. So, may Belgium take a tax? Now the rule is simple. Under Article 7.1 of the OECD Model Convention, only Germany may tax the business income apart from profits which are caused or which belong to a Belgian permanent establishment. Now, in principle, a warehouse or a storehouse would be qualifying for a PE under the basic or general definition in Article 5.1 of the OECD Model Convention. However, a special rule in Article 5.4 OECD Model Convention says that facilities or things like that where only goods are stored are deemed to be not a permanent establishment. So no permanent establishment in Belgium, and so adequately no right for Belgium to take a tax. Only Germany can tax. So the subsequent question, how must Germany react in order to avoid double taxation, is thereby automatically answered. No obligations for Germany because no risk of double taxation. As already Belgium has to step down. Article 23A would only apply if Belgium could levy a tax. So, very simple. Finished. Okay, let's talk about the next case to illustrate some other details. Here it's now the River Bank, which is a bank which has premises in London, UK and in Bonn in Germany. And the bank's branch in London gives a credit of 20 million to a German customer. The interest payments are made to the London bank account of the River Bank. So how is that to be treated? Let's have a look. And now we want to make a small variation of our approach which we had until now, because there is not only this OECD model convention in the world, but also in real life there are many different individual double taxation treaties. And now when we talk here about London and the United Kingdom, it might be a great idea to suppose, well, they will probably have double taxation treaties in English language, which we can obtain from the internet. So we could try to work and solve this text here with not with the model convention, but with a genuine text of a genuine double taxation treaty. So I tried to load down the and I did from the internet the Convention of the United Kingdom of Great Britain and Northern Ireland with the Federal Republic of Germany for the elimination of double taxation. You can find that when you search the internet for double taxation agreement or double taxation treaty, Germany, UK, and here you see it. Well, what will be our first step? We will have to look about the residence. So let's look for the residence. You see here in the beginning we have the usual things that one of the persons must be resident in one of the two states, otherwise all the formula of the DTT would not work. That the taxes covered are only taxes on income and corporation taxes and things like that, and on the wealth tax or capital tax. Then you have a chapter with definitions, and in that chapter you find Article 4, the rule who is resident in which place or country. And here we see Article 4, a resident, for the purposes of this convention, but only for reading this convention, the following agreement is made: that the term resident of a state means any person who under the laws of that state is liable to tax therein by reason of his domicile, residence, place of management, place of incorporation, or any other criterion of a similar nature. And this term, however, does not cover a person who is liable to, let's call it, only a limited tax liability on inland income. This should allow us to solve already the first step of our riverbank case. So let's make a note and write that down. So number one, again, is residence. The riverbank sounds as if they have they have registration and headquarter in London. Which is just assumed here, as I saw just now. Sorry for the really simple mistake in the collection of or giving of the data. So I'm sorry for that mistake, but that makes clear resident in the UK Article 4.1 DTT Germany UK. Now naturally it's clear that the mere existence of premises in Bonn in Germany does not lead to a place of management or so, something like that here in Germany. So that's it. Okay. So we will have to think about the treatment of the invents. And the first question now would be, can Germany, as the state of residence, or this as a state of the source state, sorry, and or the state of non-residence, can Germany levy a tax? Well, that's probably the same stuff as always. It will be in the OECD Model Convention, Article 7. So let's have a look what it is in the British treaty text. So Article 5, permanent establishment. Article 6, immovable property. And let's have a look, Article 7, business profits. So it's the same article. Profits of an enterprise of a contracting state shall be taxable only in that state unless the enterprise carries on business in the other state through a permanent establishment which is situated therein. Now, if the enterprise has a permanent establishment in the other state, the profits that are attributable to that permanent establishment can be taxed, but only them. So the profits can only be taxed there if they belong to the permanent establishment in that other state. And now, under which conditions are they attributable? Those which that permanent establishment made, not others. So that's 7.2. So let us go on writing that down. So although the customer is German, Germany cannot tax the profit from this transaction because the German permanent establishment is not involved in the creation of this profit. See Article 7.1 and 7.2 of the Double Taxation Treaty between Germany and UK. Then something is clear: how must GB react to avoid a double taxation, the country of residence? And the answer is there is no obligation at all. Article 23b, that's the one which Great Britain usually uses. OECD Model Convention does only apply if the source state may levy a tax. Now, see where we can find this in the concrete text in the Double Taxation Treaty, Germany-UK. That might be still interesting to find that. So let's have a look. So as you can see here, Article 23 in the OECD model has indeed the number 23 also in the British Double Taxation Treaty. And as you know, because states have variant or different ideas concerning if they want to copy the A or B variant of Article 23 OECD Model Convention, usually the approach is that every state promises in Article 23 that they are going to use the best method which under their law and culture is available, but they don't promise the same. So Germany will usually promise to grant exemption wherever it seems appropriate, whereas Great Britain, as a credit method state, usually only promises to apply the credit method wherever necessary. So you have here, as in many genuine double taxation treaties, or in most of them, you have the approach that Article 23 has two sub-paragraphs. First paragraph, applicable if the person in question resides in Germany. That's not our case because we have the Rivers Bank, a British bank. And then we have a second paragraph, which is here relatively small, subject to the provisions of the law of the United Kingdom concerning the details. There will be a credit against the UK tax, and that will be the German tax payable under the laws of Germany and in accordance with this convention. You see here that there are, again, conditions. Credited will be German tax, which is payable under German law, and only to the extent under which or to which this convention allows German tax. Well, and then there are some other details which do not apply in our case here. So that's indeed confirmed. Article 23, paragraph 2 of the DTT Germany UK just says Great Britain would have to credit, but only if there is a German tax allowed, which is not here. So we have to add Article 23, paragraph 2, DTT Germany UK, Britain, UK only obliged to give a credit if tax were levied in accordance with this convention. Which is not the case. By the way, I made a very great here because I changed the spelling, which is, as you know, usually not correct. When you make a literal citation, you have to take over everything perfectly as it is written in the original source. However, here we are a bit under time pressure, so that is why I cannot always guarantee that. Okay, case again, closed, finished, and solved. So let's look for a next case. So case number 4 is about something which sounds at the first glance a bit strange. The Frankfurt Factory AG has its headquarters at Frankfurt. There is also evidently the place of management and the registration. And it transports now a production machine with a market value of 400,000 to its branch in London, UK, to have it used there in the future. The book value, so the carried amount, as one would also say, is only 100,000. Later, the machine is sold for 500,000. Now, how is the gain taxed and which article or which articles of the DTT are relevant? That's the question, and we are going to look for an answer soon. First step will again have to be the residence. And for this, we will have to look to the English DTT again, and probably it was Article 4.1, DTT Germany, UK. So the Frankfurt Factory AG is resident in Germany because only there it is subject to an unlimited tax liability. If you want, you can see, compare number 1 of the German KSTG. However, we just courageously said this without checking it, so we should check it before we go to the events. So let's have a look to the British treaty and then check if it's really 4.1 and if it really says what we supposed that it says. And indeed, here we have again what we supposed in the beginning. The term resident of a contracting state means any person who, under the laws of that state, is liable to tax therein by reason of his domicile, residence, place of management, place of incorporation. That is true for Germany, and that is not true for the UK. So indeed, under 4.1, we have the Frankfurt AG resident in Germany only. Then, by the way, the next step will be the events. And that means for us that we should also have a look. Taxation of the later gain. Where do we find gains? That's Article 13 in the OECD model. And so let's look for Article 13. That would be our first guess here. But it's also in the British Treaty has the number Article 13. However, it might vary from time to time a bit, so it might be Article 12 or 14. No, here indeed it's also indeed Article 13. Gains derived by a resident of a contracting state from the alienation of immovable property. No, not our case. Gains derived by a resident of a contracting state from the alienation of shares. No, not our case. Gains from the alienation of movable property. That's our case. Sorry, movable property. No, here. That's movable property. Forming part of the business property of a permanent establishment which an enterprise of a contracting state has in the other contracting state may be taxed in the other state. So here's a plain answer. The gains from selling that machine when it belongs to the branch in London can be taxed in London. So that's an interesting consequence. Let's make a note and let's talk about what that means. So, may UK take a tax? And the answer was UK may take a tax for the asset which belongs to the UK's permanent establishment and is movable property. Now, that is the case for the machine, but only from the moment of the transfer onwards. And that has an interesting consequence, because there are now two possible ways to interpret that. The first possible interpretation would be that you say, okay, from the moment onwards when that good crossed the border, Germany is completely out and is only allowed to tax until the last moment when the good crosses the border, and then Britain is allowed to tax the whole 400,000 of a later profit. However, that would not reflect economic reality. The other interpretation would be, yes, the gain for all the time during which the asset belonged to the British PE can be taxed in GB, but not the gain which was caused in a time when the asset belonged to the German headquarter. So you can either interpret this Article 13 rule, confer Article 13.3 of the DTT Germany UK. You can either interpret that in a formalistic way, so later only UK is allowed to tax the whole 500,000 minus 100,000 equivalent, that's 400,000 gain. Or you can interpret it in a more reasonable way, or more according to an economic interpretation. Article 13.3 gives the right to tax a gain in the, or an increase, gain, an increase in the value of an asset which was caused during the time when this asset belonged to the PE in UK. This interpretation would only grant the right to tax the last 100,000 of the increase in value to the UK, because the first 400 minus 100, i.e. 300,000 of the gain, had been made, achieved, caused when this asset was part of the movable property of a German permanent establishment. Now, when you think about these two interpretations, which of them is probably preferable under the aspect that you should interpret such a double taxation treaty, let's say, in a reasonable way? Probably the economic interpretation, which looks to where gains were caused and not, which would not allow that you can shift gains arbitrarily to a different country just by shifting the asset. So this second interpretation is preferable. However, you will see that in German national law and many other domestic laws, the legislators were relatively cautious and decided to install some exit taxation or things like that, which already triggers taxation at the moment when the good crosses the border. However, if you really interpret that according to the economic interpretation of the rules, then this means when the good is sold, UK has the right to tax the last 100,000 increase in value. Germany retains the right to tax the first 300,000. So what has Germany to do to avoid a double taxation? That's Article 23, one of the DTT, Germany, UK. Germany will exempt. However, if you see that economic interpretation, here you see something very, very clearly, which in former times was also consent in Germany, even in the fiscal administration, that changed only approximately around the year of 2000 or so. The idea was, yeah, the DTT gives, when there is a sale of that asset, the DTT gives the right to tax these gains which arose in the time during which the asset was part of the British PE. That gives that right to Britain, and all the rest is retained for Germany. So the first 300,000 are retained for Germany. So Germany can even tax that asset when it is sold and when it is already in England, because only the gains after crossing the border are granted by the DTT in this interpretation to the other state. So we could still tax the first 300,000 even if the good has already crossed the border. This interpretation is preferable under economic aspects and also under aspects of the applicability or compatibility of the rules with regard to the European fundamental freedoms. Okay, so another case. It's number 5 now. An enterprise in London, UK has its headquarters and only permanent establishment in London. Now this enterprise wants to invest some capital, and they buy a piece of land as a mere capital investment in Germany, and they don't run a shop or something like that there themselves, but they just rent it out to tenants. So perhaps to another factory, or might be private people who live in that building or use that piece of land as a parking lot, I don't know. Well, so now the manager of this London, UK Limited says, well, Article 7 says business income can only be taxed in the country of residence. Apart from the case where you have a permanent establishment abroad, we don't have one. So he says, as we run a business, then Germany is completely out. Everything goes to our country of residence. And the question which I want to pose here is that true, or is there something else somewhere to find in the double taxation treaties? A different solution. Let's have a look. Yeah, to check our idea, indeed we see in Article 7.1 that profits of an enterprise can only be taxed in its country of residence when it has, or if it has, no permanent establishment in the other country. Now, Article 6 would say the income from a piece of land goes to the country where the piece of land is located. They can tax, and the country of residence must then avoid the double taxation. Now, Article 7 seems to say something different. However, at the end, you see this Article 7.4. It says, where profits include items of income which are dealt with separately in other articles, then these other articles still remain applicable, so remain valid. So here we see that something is done by an enterprise, which is mentioned in another article, doesn't spoil the fun for the source country. You could say it or see it this way. Usually, the distribution articles just say which rights to tax the source country has. And if you have no right under Article 7, but get a right to tax under a different article, that counts. So Article 7 cannot be used to, let's say, to cancel the effect of the others. which makes sense. Otherwise, everybody would just try to achieve dividend income, interest income, license income in form of a business, and then the source country would always be out. That makes no sense. So Article 7.4 just confirms our manager is wrong. The source country can still tax. And Article 6 said, yes, rental income can be taxed where the enterprise is located, where the piece of land or the building is located. So that is our conclusion, which we can draw. So let's begin again with the residence of the taxpayer. That's London under Article 4.1. The events may Germany tax Germany has a right to levy a tax on the income derived from immovable property which is located in Germany. See Article 6.1, DTT Germany UK. Article 7.1 does not give Germany a right to tax, but that does not matter here because it does not abolish, cancel, replace, hinder the rights under Article 6, see Article 7.4. Yeah? That's a kind of a clarification. So whenever one of the articles between Article 6 and 21 gives you a right to tax, then you have a right to tax as a source state if not a special rule explicitly excludes it. So what must GB do to avoid double taxation? And we still remember that that was Article 23, paragraph 2 of the DTT Germany UK. That is, UK must credit the German tax which is levied in accordance with this treaty. So must credit the German tax to the UK tax on that rental income. And that's it. Yeah, and here's the next one already. The A Limited in London has headquarter and registered office in London, but it also owns a factory in Germany, so there is a permanent establishment in Germany. The employees working in the headquarter acquired an order for an amount of 1 million, but it was carried out in the factory in Germany and the finished product was delivered from there to the customer. Now, in that business sector, let's assume that it's customary to pay a commission of 10% to an agent who would acquire an order. Now, next question, who is allowed to tax what in this situation? Let's have a look again to the DTT, and for sake of convenience, we take again the UK text. So the first aspect is again the residence, and well, that's boring, yeah, isn't it? A Limited is resident in UK because it's only subject to a tax on worldwide income. There, see Article 4.1. And why do I speak about the tax on worldwide income there? Because the expression which you find in Article 4.1, that you are subject there to a tax because you reside, you live there, you have your place of management there, or similar criterion, that means nothing else than a worldwide tax. The events. May Germany tax? And the answer is business income may only be taxed in the UK, that's country of residence. Apart from that income which is earned by a permanent establishment in Germany. So here is the PE in Germany, so Germany may levy a tax. See Article 7.1 of the DTT Germany UK. However, the following question immediately comes up. What is the amount of income which is caused by the German PE? To find out which income has or belongs to the German PE, one has to treat the relation between PE and headquarter as if these two were independent businesses doing business based on market price with each other. See Article 7.2. So we have to do as if the PE in Germany would have to pay for the headquarter, to the headquarter, a commission like the market would usually require it. So 10% of 1 million, that's 100,000, go as profit to the headquarter. The remaining 900,000 are that part of the revenue which is regarded as earned by the PE in Germany, which fulfilled the order. Okay. How must UK react? Well, they must credit the German tax on the German 900,000. Not on more. If Germany were to tax 1 million, then the UK would say no, the tax on the last 100,000 is not levied in accordance with the treaty, because the treaty gives us the right to get that the tax on that 100,000, and not the Germans. Yeah, that was Article 23, paragraph 2 of the DTT Germany UK. Also, that is closed, finished, and solved. Well, the next one. We have again a British Limited. It's now the B Limited, and it has registered office and place of management again in London in the UK. You see, today I have a really enormous imagination. It's always London, UK, and so I pretend to be sorry. And this has a permanent establishment in Cologne, which is in Germany. Now the B Limited gets a royalty from Germany for the permission to use a certain patent right from a German, or for the permission to use a certain patent right, and this payment comes from a German GmbH, which is not related, and so on. This patent right, however, had been developed not by the British head office, but by the German permanent establishment of B Limited, and it still forms a part of the business property of that permanent establishment. Now the question arises if Germany can tax or cannot tax. The managing director of B Limited thinks that Article 12 forbids Germany to tax their license payment. However, the German administration thinks no, we can and we will. Now, how is the case correctly solved? So, who is right of them and why? Let's have a look. Okay, something which is completely unproblematic apart from the necessity to type it down, although there is such autocorrecting system which always is a pestilence. But under the legal aspect, very simple, is evidently the residence question. B Limited is resident only in the UK, Article 4.1 of that DTT Germany UK. We have already looked that up several times, so trust me, it will be true. Now, events. Can Germany levy a tax? Article 12.1, royalties, does not give Germany a right to tax. It says only UK may tax. Okay. First, before we go on, we should naturally check this so that we are sure that it's correct, and otherwise we would be, as we say in Germany, perhaps in the wrong movie. So we would watch a complete wrong play, or we would base everything we do on the complete wrong assumptions. So let's check it. And yeah, checking is done relatively easily and quickly. Royalties arising in a contracting state and beneficially owned, so economically actually owned, by a resident of the other contracting state shall be taxable only in that other state. Let's fill in the variables. Royalties coming from Germany, contracting state, and going to a resident of the UK can only be taxed in the UK. So that's clear. 12.1 says taxes on royalties cannot be levied by Germany, only UK can tax. However, you remember the basic system. Article 6, 221 only decide if the source country may get a tax. And usually when you don't get a right to a tax under Article 12, that's not a reason why you should not get any right to tax under a different article. So when you get a right to tax, you keep it until it's explicitly excluded by a special clause. But usually, whenever some article gives you a right to tax as source country, you can tax. So let's have a look. Here, the royalty is also part of the profit of a permanent establishment. So we might also have a look to 7.1. And 7.1 says the profits of an enterprise shall be taxable only in the state of residence, okay? But then the modification comes, unless the other one, the enterprise doesn't carry on business in the other state, so in Germany by a permanent establishment. If that is the case, then the profit of the permanent establishment can be taxed. So Article 7.1 and 7.2 would grant to Germany a right to tax because they can tax the complete amount of the profit of the permanent establishment. Now, there seems to be a contradiction. It would be nice if there is a clarification. 7.4 just gives the clarification the other way around. What happens if the business article says no and another article says yes? So this is not the rule which we need. We need a rule which says if 7 says yes and another article says no, then 7 then still counts if it gives something to the source state. let's have a look for this in 12. And indeed, at the end of 12.3, you find this. The provisions of paragraph 1 shall not apply. So that the royalty can only be taxed in the country of the recipient, so GB, shall not apply if the beneficial owner of the interest, wrong movie. That was indeed wrong movie. But here we have the parallel rule in 12.3, shall not apply if the owner of the royalties, being a resident of a contracting state, carries on business in the other contracting state in which the royalties arise through a permanent establishment. In that case, Article 7 shall apply. So that's exactly the rule which we need for confirmation of what we wanted to say. If Article 7 gives the right to tax to the source state keeps that right. If Article 12 gives the right to the source state, it would also prevail. So you can say the general idea seems really to be that if one of these articles 6 to 21 gives the right to tax to the source state, it's usually not revoked by any other article. So you look through the distribution articles if there is a right to tax granted to the source state under any aspect, and that usually isn't very helpful. And that remains the truth. So let's add this, but the royalty is here also part of the profit of a German permanent establishment, and Article 7.1 gives Germany the right to tax the profit of this PE. So under Article 7.1, Germany may tax this. Article 12.3, DTT Germany UK confirms this by saying that in this situation, the PE article, no, the business article prevails. The article on the profit of the PE prevails, so wins. Then it's again the usual question, how must UK react to prevent double taxation? And you know, UK is a credit method state, so Article 23b OECD Model Convention would be applied, or here Article 23.2 of the DTT Germany UK credits the German tax. So German administration is right. We would have been surprised if they would have been wrong, because naturally such an administration has some experts at hand, and that probably explains much. Okay, next case. So case number 8. Here we have the German Trick AG, so a stock corporation, which has made an invention of great importance that will bring considerable license fees from all over the world during the next years, or even decades. And for this reason, they have a trick in mind, because they sell the patent right to a newly founded subsidiary of their own, the Trick Limited, on the island of Jersey. And what does the DTT Germany UK say on this, and what would be different if the Trick Limited were domiciled in London? Well, that's the case. Let's have a look and play around with it. Now, ladies and gentlemen, question A, what does the DTT Germany UK say on the trick limited in Jersey? This is a lecture or a lesson in that area which is called Life is Not Fair, because this is a convention between the United Kingdom of Great Britain and Northern Ireland and the Federal Republic of Germany. And Jersey is, under international and national law of Great Britain, not a part of the United Kingdom of Great Britain and Northern Ireland. So this DTT simply does not apply to Jersey cases, because as you can see in Article 3, the term a contracting state and the other contracting state mean, according to the contents, either the United Kingdom or the Federal Republic of Germany, and the United Kingdom means Great Britain and Northern Ireland. A bit of the continental shelf, but not Jersey, not the Channel Islands. So bad luck. The first thing we can find out or say here, the DTT Germany UK says nothing on cases in Jersey, and so we would have to turn to the OECD Model Convention. However, Germany has no DTT with the island of Jersey, so at least not a full DTT. So we can reasonably expect that license fees paid to Jersey are fully covered by German limited tax liability. Let's find it out, or let's say that. So the DTT Germany UK does only refer to cases or to persons resident in either Germany or the UK. See Article 1, DTT Germany UK, and Jersey is not a part of the UK. For this reason, the DTT does not apply to Jersey cases. See Article 3 if you want to. The definition of United Kingdom seems to be the general one, and under the general one it is not a part of the UK. So one would have to turn to the DTT with Jersey, and the question is then, is it OECD Model Convention? And the answer is there is no full DTT with Jersey, only an agreement on cooperation in certain tax matters. So not a full DTT. So license payments to Jersey will be fully subjected to the rules of German limited tax liability. So that famous trick of the trick, AG, was what we could call a shot into the oven. It went completely wrong. It didn't hit the target, but went somewhere, led to an outcome which was not pleasant. Well, now, what if Trick Limited were located in London? Then it's clear, then the DTT Germany UK would apply, because London is UK. See Article 3.1 if you like to. Germany, UK. I don't cite it in detail, too boring. Yeah, residence. The Trick Limited would be resident in UK, Article 4.1, DTT Germany, UK, the TRIC AG would be resident in Germany, Article 4.1, DTT Germany, UK. Let's talk about the events, the license payments. We had that Article 12.1 of the DTT Germany, UK, which says license fees, royalties can only be taxed in the country of residence of the recipient, and the recipient is here the TRIC Limited, so only in London, UK. UK would have to do nothing to avoid double taxation. And now we come to a but, because here you see they sell the patent right to a newly founded TRIC Limited, now in London, and the idea is probably and evidently that they want to save taxes by this transaction. It's a completely artificial transaction. A patent right invented or obtained by research and development made by the TRIC AG is sold to Britain because it might be, at least in certain cases, it had been possible, at least in former times, that you could obtain very good tax conditions for license fees there. So it is to be presumed that the whole maneuver is mainly or substantially motivated by tax-saving reasons, and this leads to a special article in the DTT, the so-called principal purpose test. That is a test which had been established by the so-called Multilateral Instrument. In most of the existing double taxation treaties. See Article L, let's look it up, which one it is, and test it. Here you can see recently inserted into the double taxation treaty text in Article 30A, prevention of treaty abuse. And this article says, notwithstanding the other provisions of these conventions, so unharmed by the other rules laid down here in this convention, the following rule has to be applied with prevalence. A benefit under this convention shall not be granted, so will be denied, in respect of an item of income, if it is reasonable to conclude that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it can be established that granting that benefit in these circumstances would have been in accordance with the object and purpose of the relevant provisions of this convention. So now let's sum this up and evaluate this rule. Here we have a situation that people outsource the patent right to a foreign artificially created taxpayer that's a subsidiary in London, with the intention to avoid German taxes on the income of the patent right. Can it be reasonably assumed that the two contracting parties would have regarded this, both of them, the two of them, as in full compliance with the treaty, of what the treaty wanted to enable people to do? And the answer is probably safely a no. So the principal purpose test of 30A here says the privilege is granted under Article 12, that Germany does not have to tax the royalties, is denied under 30A for this constellation, which means Germany can fully tax. So that was Article 30A, and that says the benefits of the treaty, i.e. the rule that Germany must not tax the royalty payments, will be denied to the Trig Limited because the whole arrangement was mainly, or at least substantially, so as one of the main motives, motivated by the wish to save taxes. So Germany can and will fully tax the royalty payments under its rules for limited tax liability. Let's go to B. How will UK have to react to avoid a double taxation? Article 23.2 says UK must credit the taxes which are levied by Germany in accordance with this convention. Now, as the German full limited tax liability taxes are due to Article 30A in full accordance with the treaty rules, UK must credit them. At least that is to be supposed. Article 30A does not cover this benefit denial, so this can not be denied, is at least my opinion, because now GB could say, we stick to the basic situation, which says only we can levy a tax, and we deny the credit of the German tax. However, the treaty rule allows Germany to fully tax under limited liability rules, and 30A does not allow GB to deny the credit because the whole maneuver was definitively not aimed at getting the GB tax credit. So that was not a benefit which should be artificially generated by the whole construction. So I see no reason why this benefit could or should be denied. But in the end, here you see that also our Trig Limited, if it were domiciled in London, would obtain no advantage from that constellation. That applies due to the new rules which have been inserted in most of the present day double taxation treaties as a consequence of the so-called multilateral instrument, which was signed some years ago. So here is another nice and it's rather a case for advanced people. However, don't be shocked too much. Let's first have a look to the situation. C GmbH is in Cologne, Germany, and it has a permanent establishment in a foreign country. Let's call it Bulgaria. So it's a foreign state, and it has a corporation tax of only 5%. Now, under German law, due to a DTT with the state of Bulgaria, this revenue is exempted from German tax. Such a thing is possible if, for example, the DTT with Bulgaria was made in a time when this still was a high-tax country, and nobody ever expected them to lower their taxes so massively downwards as they did later. In Germany, the tax level is 30% still, approximately for a GmbH, that is 15% corporation tax and approximately 15% of trade tax. Now, C GmbH obtains a royalty payment for a patent right from an English company, 500,000 euro. Now, this royalty payment, however, does not go to the headquarter, but to the permanent establishment in Bulgaria, so in their low-tax state. And the English now signed Article 12 with regard to Germany. They had the idea, okay, if license fees go to Germany, Germany is a high-tax state, there will be no tax-saving models to fear, so we can sign this. So we sign a rule which says everything which goes as a license payment to Germany is fully excluded from taxation in the UK and will only be taxed in Germany, which has only one effect: GB is out. The Germans have the right under the treaty, but they can renounce on this right with regard to others, which they evidently did here. So the German company thinks that's nice now, because under both Article 7 and Article 12, the English do not have any possibility to tax this royalty payment. Under Article 12, a royalty payment which is made to a German national, so a German GmbH, cannot be taxed in England. And under Article 7, you cannot also not claim this license fee as a part of an English permanent establishment. So you can check all these articles. No article gives a right to tax to this amount of license fee to the British. So in the end, although the British had the idea that they concluded rules, a DTT with a high tax state, in the end, due to this double taxation treaty in combination with another double taxation treaty, the money ended up untaxed nearly untaxed in a low tax state. And this is nice. I show you the constellation again. We have the German enterprise and we have the British company. Now a license fee is going to be paid, but now the internal structure of the German enterprise is as follows. We have the German headquarters and we have the permanent establishment in Bulgaria. And due to the DTT between Germany and Bulgaria, German taxes are excluded when it comes to Bulgarian PEs. Now we have this license fee. And it goes from an English company to a German recipient. So Article 12 would exclude England from any tax. So in the end, what happens here in a three-country case is indirectly England making a DTT with a high-tax country ends up with having to free the 500,000 royalty payment from from all their taxes, although it now ends up in a low-tax country with which they never would have concluded a treaty with these conditions. So how can the DTT cope with that? And in former times, the answer would have been plain and simple: it can't. But due to that multilateral instrument, that famous MLI, the treaty has been changed, amended, with a clause aiming at situations like these. Let's have a look. Here we have a look on the protocol to the DTT Germany UK. You see protocol here. And a protocol is something like the small printed letters of a double taxation treaty, or in general, it is a kind of the small printed letters of any international agreement. And as the small printed letters in a contract which you sign with another contracting partner are valid parts of the contract, although they sometimes contain surprising clauses, we here have the same basic constellation. A protocol to an international treaty just contains some clarifications or additional agreements or special arrangements where two states involved confirm that they agree that certain parts of the main text shall be understood in a specific way, or that they agreed that certain clauses, although they are widely expressed and formulated in the main text, do not agree to certain specific constellations or things like that. The important thing is what is written down in a protocol is a fully binding part of the international agreement and might, for several constellations, contain a complete revocation of what is written in advance. So let's have a look on this here. With reference to the Articles 10, 11, and 12, the royalties, for example, there is a common understanding between the two contracting states in the protocol that where an enterprise of Germany gets income from the United Kingdom, and this income belongs to a permanent establishment which that German enterprise has in another country, so here in Bulgaria, the tax benefits that would otherwise apply under the other provisions of this convention. So the tax benefits which consist, for example, in that royalties must not be taxed in Great Britain if they go to a German company, that these benefits will not apply to that income if the combined tax that is actually paid with respect to such income in Germany and in the third jurisdiction. So if the German tax and the Bulgarian tax together do not make up at least 60% of the tax which would have been payable in Germany. So the idea is evidently when our permanent establishment would not be in Bulgaria, a low-tax country, but in a high-tax country like France, then we would have no problem with that. Or if the tax of France or Belgium or even Bulgaria were only a bit lower than the German tax level, then they would still think, okay, this is not a tax-saving construction, this is not dangerous. We would have agreed to grant this benefit also to a Bulgarian permanent establishment if, let's say, the Bulgarian tax level would have been 28% instead of the German 30%. That would not be any reason for a debate. But when it's less than 60% of the German level, then alarm. Then the benefits of this treaty are not granted to this payment. However, then Great Britain can levy a tax in full extent because Article 12 does not limit it anymore. And now they could take 100%, which would be a bit much. And so an alternative upper limit for the British taxes on these payments is then agreed on. Any dividends, interest, or royalties to which the provisions of this paragraph apply shall be subject to a tax at a rate that shall not exceed 15% of the gross amount thereof. So the English can, in that constellation, so levy a withholding tax of up to 15% on the license fee which goes to Bulgaria, in spite of the fact that the recipient is a German, and Article 12 would normally exclude this. That is explicitly clarified here in the protocol, and it's a good example for that a rule in a protocol can directly contradict and overrule a rule in the main text. These provisions of this paragraph shall not apply in case of royalties if the royalties are received as a compensation for the use of or the right to use intangible property, which was produced or developed by the permanent establishment itself. So if our license fee goes back to a patent right, which from the beginning onwards was the fruit of the active business of the Bulgarian permanent establishment, then they regard it as completely in order, because then it's not a tax-saving construction, then it's a result of genuine business, and then they think we have no reason to deny the tax advantages of this three-country constellation in such a case. But when, let's say, the invention was made in the headquarters and later transferred to Bulgaria, then it stinks. It smells a bit of the wish to save taxes by this specific construction, and here the DTT contains a kind of a stopper. So what does that mean for our case? Let's have a look again. So the C GmbH is resident in Germany, Article 4.1 of the DTT Germany UK. So under usual rules, UK would be forbidden to tax the royalty payment under Article 12.1 DTT Germany UK. However, as the royalty is paid to a German national, German company, but collected as part of the profit of a PE in a third country, here Bulgaria, the protocol to Articles 10, 11, 12 of the treaty says that the usual rules do not apply if the total tax burden on the royalties in Bulgaria plus in Germany do not amount to at least 60% of the usual German tax level. That seems to be the case here, as the German tax, as the Bulgarian tax is only 5%. That is less than 20% of the usual German tax level, so less than 60%. In that case, UK could tax the royalties with a tax of up to 15%. But by the way, under national law of Germany, in many such constellations, Germany would revoke the tax exemption granted by the DTT Bulgaria on its own under the rules of the German so-called CFC legislation, and therefore the German tax, the total of German tax and Bulgarian tax would no longer be too low, so that Article 12 would again apply. That's the case. So again, a case, this time only with a very small remark and not with an explicit and long solution in all probability. German D GmbH wants to lower its German profits. Therefore, they use a 100% participation in English limited company, the E Limited, which has a huge loss carry forward of approximately 100 million euro, so that this English company will for a long time pay no taxes in England at all. For this reason, the D GmbH sells a patent right for an invention which they had made themselves to the British subsidiary. They now pay annual license fees of 1 million to the British subsidiary. Under the usual rules, they were not allowed to tax the license fees, Article 12. And so the license fee is a business expense for the D GmbH and cannot be taxed under limited tax liability when it goes to the British company, the E Limited. So this lowers their German tax base. The amount leaves Germany free of German tax, and in the UK, due to the huge loss carry forward, it will remain untaxed too. And so 15% withholding tax, which otherwise would have been collected, can be avoided. And the amount also lowers as a business expense the profit of D GmbH. So D GmbH gets away with no payment on these royalty payments, or the group at all. The question is, does this work? And the answer is, think again about the newly inserted Article 30A about the principal purpose test. If you see that maneuver here, then it seems convincing that at least tax saving was one substantial motive behind doing this transaction here, if not the only one. And for these cases, Article 30A said, the benefits of the treaty will be denied. So Article 12.1, that Germany has no right to tax, that will be denied due to the principal purpose test, so Germany can fully tax. So Germany will take 15% license fee withholding tax, and so the whole maneuver becomes senseless. The British will then have to credit the German tax because, as Article 30A allows this taxation, it is German tax which is levied in accordance with the treaty, and this has to be credited to the British tax under Article 23, paragraph 2. So we don't need a fully written solution for that. Some other thing might be interesting, a last short case, again on the definition of what a permanent establishment is. The BAMA zone, SRL, so that's a Luxembourgish or French, in that case Luxembourgish GmbH, is a limited company established in Luxembourg. It is active in the online business and has warehouses throughout Europe. And whenever customers order goods online, these goods are sent from one of the nearest warehouses directly to the customers. And now under Article 5 OECD Model Convention in the old version, one would expect that a warehouse is not regarded as a permanent establishment. You remember that beer factory with the storage room in Belgium. So all the profits made by BAMA zone would only be taxable in the country of residence, so only in Luxembourg, although they cover the whole European market with a network of a mass of warehouses. The question is, does this still work under today's legal situation? And to find this out, we naturally need to take a look again into the OECD model, or for sake of convenience, because we just have it at hand, we find probably the same clauses in the British treaty. I don't have the Luxembourgish at hand at the moment, so let's turn again to the British one. So when we have to look to our case, the decisive thing is Article 5, the definition of a permanent establishment. And the basic rule is a fixed place of business through which the business of an enterprise is carried on. That would apply to a warehouse. However, 5.4 says, in the traditional version, in contrast to the preceding provisions, or irrespective of them, The term permanent establishment shall not include the following things: the use of facilities solely for the purpose of storage, display, or delivery. That is exactly what Amazon does. Of goods or merchandise belong to the enterprise. So that would not be a permanent establishment. However, the basic idea beyond that was originally the thing with the beer factory. You produce beer in a factory, let's say in Germany, and then you store the finished beer in Belgium. And that would bring along the problem: which amount of the total profit is caused by the production and which of by the fact that you don't throw it away immediately afterwards but store it. That's a completely unsolvable question. And what evidently the legislator had not in mind was cases where the whole activities of a transaction were only done by this warehouse and by automatic devices. So Amazon, as an online shop business, collects orders online, and the only thing they do in real world activities is they buy goods, store them, and deliver them from the warehouse. So you could say everything combined with the transaction is done from the warehouse. And that is where this warehouse simplification solution don't regard a warehouse as PE, because it does not contribute to the profit substantially, and it poses unsolvable problems where both justifications fall away. Here we can say the complete gain from the transaction is connected to nothing else than this warehouse. No other place on earth has a closer connection, and that is why they say in the newly inserted paragraph 4a, in all DTTs which have already seen a revision due to the multilateral instrument, 4a, paragraph 4 shall not apply to a fixed place of business that is used or maintained by an enterprise if the same enterprise or a closely related enterprise carries on business activities at the same place and the same contracting state. And if the overall activity resulting from the combination of activities carried on by the enterprises or by the same enterprise or closely related enterprises is not only of a preparatory or auxiliary character, provided that the whole thing constitute complementary functions that are part of a cohesive business operation so that it belongs together. It's a very, very complicated way to say that if a complete business cycle, so a complete transaction, buying things, storing them, reselling them, happens in a single location, this single warehouse will not be disqualified as a PE, but then it will count as a permanent establishment insofar, so that this will then be taxed. Yes. So I think that's enough for today. Goodbye, and thank you for listening, if you listened. And please do not forget to recommend the channel to others whom you like, if you liked it, and to others whom you do not like, if you did not like it. Thanks and goodbye. It might be nice if you press such a like and share button or some other buttons, and if you come back soon to the channel. Have a nice rest of the day. Ciao.